This is a video on, and it's the first video. It's the first video on M&A theory, and I call it theory and analysis. It's really theory and Excel files to go along with the theory. Okay. Now, I have excuse me for that, I have a new director who's telling me giving me some very helpful suggestions on the videos. And he says, he doesn't say don't swear. Well, he does. Well, okay. But he says, keep it structured, keep the theory apart from all this technical stuff. Put a big warning out there when you're going to do a whole bunch of Excel things that's going to put people to sleep. Okay? And keep it more structured. So, and keep the videos short. And probably a whole bunch of other things that I can't remember right now. So, this is the theory part of it, and there are other videos that I actually have already made that go along with some of the technical aspects. And he also said, show people where the files are, show where the files are, show where the files are. So I'm going to show you where the files are as well. I'm going to put those kind of in the comments. Now, in this set of videos, and he said, don't ramble too much, and I'm rambling already. But, okay, first we're going to start with the overview of M&A theory, and that's where I'm going to talk about this accretion and dilution, this economic theory of synergies and premiums. Maybe it's a little bit obvious, a little bit basic, and I'm going to introduce a football field diagram, American football, not real football. Okay. And then on this football field diagram, which is kind of a good way to start, it shows you have a ton of different valuation methods, and they can all give you different ranges. And the first is just using PE and EV to EBITDA multiples. So that's going to be the next video, and there are going to be some technical files that go with that and show you how to really get and extract that multiple data, which is the thing I'm really kind of proud of. This is the main theme of the class. And then it'll say, why are the multiples so high? They came down with the market coming down. But what's how do you explain these multiples? And then so that's the next video. And then there's another video on transaction multiples. These are multiples you pay in the merger. And if you pay a higher multiple, a higher PE ratio in a merger than you have for just a listed company or traded company, well, that implies a synergy. And there are some tax issues that get a little tricky. And then I have rambled on and on about cost of capital so much because you can't get away from it, but I'm going to briefly go through some of the cost of capital issues and review those. Then we're going to say, well, no, don't look at multiples, look at DCF. And I'm going to show you some basic modeling techniques for banks versus insurance companies versus regular old companies, and try to show you that with a really kind of simple example. And then, this is so exciting. Then we're going to go through and show you how you can just press a button and get all the history ready in a nice Excel format. And then we're going to show you some of the issues with Excel, making forecasts and getting valuations using DCF, and that's all about terminal values, really. And then we'll go through some LBO issues and implied LBO. So I'm going to start. Okay, I've talked about this already. So here is our part one. Okay, and part one, again, in the theory here, I've already discussed this, so you can look at it. Here is a football field diagram. Here you go back and forth, back and forth. Maybe you score a touchdown over here or over here. One team goes back, and then you go back and forth, and then you punt the ball. And then you go back and forth. And each of these is a different valuation technique. And each of these valuation techniques is associated with a range of values. So that's the general issue. Now, if you want to make a football field diagram, if you want to make one, it's a pain. It is a pain to get. It's a real easy thing to get these things, but to get these things is hard. And then I guess you can make your own stuff over there. And then so you have these kind of EV to EBITDA multiples, and then you have price to book multiples. These give you a different, smaller range. These give you a higher value. M&A comps, they should always give you a higher number because you're paying a premium. And if it's EV to EBITDA, you can get the premium implied. And then you have a discounted cash flow. And this is total rubbish. I'm not swearing. Because the real value of the DCF goes way out here to way out here. That's going to be the theme. And then LBO, it sounds so fancy. Oh, it's so fancy, fancy, fancy. It's basically kind of a variation of the DCF. It's saying, if we put some debt into our transaction, can we back out how much you would pay to get a target IRR, but you're going to use the same sort of cash flows and just have to make some financing assumption. And really this target IRR on the equity basis is kind of like a discount you'd use in the DCF, and you've got a terminal value in the DCF, which could be an EV to EBITDA multiple, which is what you'll put in the LBO model. So we're going to go through all of this, and finally the premiums paid just says, what's a typical premium? Maybe this is the most realistic part. You're going to have to pay a similar premium to other companies, perhaps. And can you get the value? Okay, and this doesn't add any synergies, which we're going to get to. This is just pure kind of standalone value. This is another example. Now, if in the file, now this file, there is a file, and I have a file here that's named Acquisition Modeling Exercise Complete. And this file will be on, this is just my pictures of my exchange rates. This file will be, and I'm trying to kind of improve this page, building an acquisition model from A to Z. And I'm not quite finished, but I'm going to try to get it in a very organized way where we're going to put the acquisition modeling file here, and then we're going to, here's the football field, and then we'll have some technical exercises that go along with that. I hope you can see and imagine this right now. It's going to be filled up basically as when I finish this video, because I can't put the video here right now because the video is not finished. Okay, enough. All right, and then in this acquisition exercise file, you can see how to make a football field diagram, and instead of going through all of the stuff, here, I just put the, this is the starting point. Oh, there's the final one. I didn't know. That's why I couldn't find it. Okay. If you just make a graph of these things, just make a alternate F1 graph. I'm not supposed to do this, in this file, but you make it, and you make it a bar chart and all this. The easy part of this, I'm just showing you a little tiny bit of this. Sorry about this. The easy part of this is right-click on this one, and you kind of just format the data series and make it take out all the fill. Okay, that's easy. And then you arrange the scale a little bit. Okay, you got the football field diagram, but these numbers, that is the pain, putting the numbers there. And you can walk through and see how that works. You have to put an increment for the labels, and it walks through this. And I've got another video, 2 videos at least on this anyway. So I'm not going to go crazy with repetitive stuff. Okay, now here is what I want to talk about in the theory. This is SunEdison before they went bankrupt. Look at this. It sounds so technical. SunEdison will transfer to the seller note LLC, will pledge, blah, 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 first priority Class B securities in addition to the exchange rate at all times. The Class B securities equal the full number of shares of the Terraform Power Class A stock, all in one sentence. There's another sentence of the regular date, the interest payment will pay interest, and it goes on and on. I can't read it. It's absurd. You read it. It sounds so complicated. Oh my gosh, it sounds so complicated. But here's the real point. any valuation, project finance, corporate finance, M&A, real estate, anything. It's about two things. Number one, what's the future cash flow? Number two, how much risk does that cash flow have? How you get the future cash flow is unbelievably difficult. You got to make a forecast, and anybody who makes a forecast is an idiot. That's what one of my radio that I listen to, my beautiful French radio, says. You got to be an idiot to make a forecast. And then to think you can adjust that forecast for risk, and which is a riskier forecast and not riskier forecast, that's all it is. Okay, so all this fancy language, it boils down to this. That's just like anything. M&A transactions are a little bit, they can have partial payments. You can have these earnouts. You can have, you know, accretion and dilution, all that. We'll talk about all these, but they don't make it fundamentally different. Here's the biggest problem in M&A. The biggest thing, you go to the beer, you go to a bar, you're going to go out after you've done some M&A analysis. You need a beer. And then here's Heineken. Oh, I don't know what these are. They look pretty good. But this beer, it says it's going to cost $100, and then you're going to go to the bartender and offer them $120. That's a premium. Why would you ever pay more than the listed price? I thought this would have a listed price on it. It doesn't. Who cares? Okay. The only reason, there's only one single reason you would ever pay more than the price they're stating here, and that's if you could take over the whole company. And I can't come up with an analogy for that. But you've got to take over everything. And that takeover is this horrible word called synergies. There's a wonderful Dilbert cartoon where they have synergy phobia. Oh my gosh. But the present value of the synergies have to be greater than the premium. Now that's a valuation issue. That's not fancy stuff. But here's the problem with that. Number one. Okay. First of all, if you've got a cash flow and you got some nice history, you have some nice history on that cash flow, you can make a forecast. You better use the history. My whole theme about forecasting in these sets of videos will be making good presentations on the history. That's a big deal. But the synergies are after tax, and the premium is also, they're before tax, and this premium's after tax. So you better reduce the synergies for taxes. That's kind of basic. And then, how do you know? What kind of risk do you put against the synergies? That's the hard part. Okay. Now, when you're measuring the value of a merger and all this, instead of just doing kind of standard valuation, you might want to put, okay, here's our company before the merger. Here's what our earnings per share is, our return on equity, our blah, blah, blah financial ratio. Here's what we look like before the merger. Poof! Make a model. Here's what we look like after the merger. That difference between what we as the acquirer look like before and what we as the acquirer will look at after, that's called accretion or dilution. And then there's some kind of accounting and goodwills things that affect the earnings per share. So that can be a little bit difficult. Okay. Now, if you think the target is undervalued, that's not really a reason to do the merger. You can just go call all your shareholders and say, go buy, I'm going to do you a favor. Don't buy my share, buy their shares. Okay, they can go to the market and do that. They don't need you to pay more for their shares. It just doesn't make any sense. And that can lead to bad. Marriage in hell. Mergers in hell. Okay. That, I'm not saying that. Whatever. Now, it's, here is this stupid kind of rules people make. God, I hope they don't tell them so much. If you're in the same industry, okay. All right. If you're not in the same industry, saying you can get synergies, what a ridiculous thing. Okay, so would you rather buy a company that's really good, earning a high return, or a crappy company earning a low return? Well, you'd like a low earning return company because you can fix them. But it's kind of bull. You can't, if you're buying an insurance company that's got a bunch of policies, you can't magically fix them. If you've got to buy a bunch of production plants that just aren't working very well because they're old and rattly, you can't fix them. That's the assets you're buying. Maybe you can reduce the SG&A expenses and all that. So this simple rule, buy in the same industry and get a low return, but the target should have a low return, is kind of silly. Now, so let's go through our kind of rule. Rule number one, this rule right here, synergies got to be greater than the premium. Okay? Here's an example. And now I did this example in a better way. So if you look at this file, which will be right on the disk, there's synergy and premium. And I put it over here. This company, the combined operating expenses were $6 billion. Okay? Maybe I should press Shift Control 1. Okay? Or, Shift Control D. No, can't do that. Okay? And they said, it looks like, we did some fancy analysis. We got, of this operation and maintenance for both companies together, 180 to 300 is our variation. Now, if you take 3% of this to 5% of this, what they're doing is just using some little rule of thumb. And then if you use a 12% discount rate, you get this NPV of synergies. So they're assuming what they're doing. Sorry about this. I didn't mean to press the F1, but they're just taking this. What's going on here? They're taking this number and dividing it by 12%. So that's a pretty high discount rate for the synergies. Or take this number, divide by 12%, and we get the level of the. Sorry about that. You take this number and divide by the 12%, and you get the 2,500. Enough of that. And then you can say, here's how much they paid for the company. 22 was the share price before the merger, before the announcement. You got to figure out kind of what premium really means. Premium is how much you pay more than the share price was just the minute before the merger was announced, as if there was no leakage or nobody knew about it before. So then, or there were no rumors. So you take 22 times 264, that's the market capitalization. There was a 37% premium, and you get that the premium value was $2.1 billion, which, if you take these synergies and you say, these synergies are pre-tax, not after-tax, we better take a tax rate, which this company had about a 40% tax rate, and then we get a much lower synergy. The economics of this are a bad deal. It's a bad deal. Now, in the technical part, I walk through how to make this in a kind of fancier way where we wait with the penetration. We say, no, we could get it all right up front, or maybe it goes 25 to 100%. We interpolate. We figure the IRR on the whole thing. What's the IRR? Now, if you have a synergy percent of 5% and you allow it to grow with inflation a little bit, then you get a IRR in the merger of 8.2%. You have to figure out, is that worth taking the risk of the synergies? That's kind of 101. That's rule number one that you should kind of remember about all this. Now, next thing we can do is say, no, we're going to look at accretion and dilution. Okay, this is a little, and here's what I made a picture, and it's all about exchange rates, or this example is about exchange rates, and this example is understanding that the stock price of one company is the currency. So if we exchange shares in a merger, it's basically, it's like exchanging euros for dollars, or something like that, okay? And in this example, I had a little example. This is from the insurance business. Lincoln National had a PE ratio that was fairly low. the next company, Principal, had a PE ratio that was high. So we have Principal buying LNC. Excuse me. The exchange ratio, you take it's like if right now if it's 1.2, the exchange rate between euros and USD is 1.2, you get 1.2 USD for each euro. Now, so the acquiring company in that case would be the euro, and the target company would be the USD. And then you go to this booth over here and you say, no, I'm going to give you more. I'm going to give you a higher rate than this. That's kind of what a premium is. And then you work through the future revenue forecast, earnings per share forecasts for both companies. Now, I'm so proud of this that I got to open something else, and I'm going to press this to manual. Now, I'm going to put this file up here, but I've got a whole bunch of these files, okay? And this is a file. I hope it's opening, and it is a file that goes and downloads all of this stuff. It goes and in this case, I'm downloading Google, Amazon, BlackBerry, Vodafone, whoever. Okay? And then once we download these, we get all the earnings forecasts. And so this has got Walmart. So if I want the Google, that shows me what the projection for the earnings per share growth is, what the next year's earnings per share is, what the PE ratio, what the current share price is. And in this exercise that I'm not going to do right now, there is a technical Excel exercise that just walks through this whole thing and shows you if you pay a different premium or discount. And I used a crazy example. I said, let's have Google buy Apple. No, Apple's bigger than Google by double maybe in market value, more. Okay. And then we put different levels of synergies in. But the point is that Apple's share price is, or Google's PE ratio is, this is just the earnings, but their PE ratio is higher than Apple's. And if you're buying, here, this kind of has it. If you're buying a company and if your PE ratio is higher than theirs, it's like you're taking their bucket, you're taking their earnings and magically exchanging them, doing your little exchange rate business and having them worth more. Well, that business can't last forever. Now, here, let me just get to the real point. When you do this, here in this case, there were no synergies. Okay, there were no synergies, and you can go through and all the technical analysis, see how it works. It's so easy. It's kind of ridiculous. I'm doing what a finance person does, try to make it more complicated than it is. If you have no synergies and this company has a lower PE ratio than this, at the end of the day, this is the earnings per share on a standalone basis for the acquiring company. They're the acquirer, and the consolidated earnings after the merger are higher, even with no synergies, even paying a 20% premium. So this goes exactly against the whole business here. But in the real world, that's what's going to happen. The CEO is going to look at this kind of stuff, or CFO. What's going to happen to me with my earnings? And this is just a way to introduce some of the kind of issues. Okay, now I'm just going to finish this off by saying, let's go back to our fundamental principles of valuation. There are kind of two things you got to do: future cash flow and risk. The big problem with all of this is that this is way back, 1980s, LBO boom, Drexel Burnham, okay, and what's his name? And they were doing. There was the LBO boom, but here's the point: many of these transactions were based on assumptions that companies achieve levels of performance, revenue growth, operating capacity that had never been before achieved in the whole industry. Now that file I showed you, we can do this. This was a file where we showed Google and Apple. We can show what the revenue growth is, and you can look across at an industry. And if you don't look at history for all of the not cash investments, returns for all of the stuff. Okay, let's take somebody else. Let's just take Home Depot. Okay, what happens to all of their kind of revenue growth? Are you going to assume revenue growth is faster? And then you can look at the whole industry. They didn't have R&D and depreciation rate. You can look at all these, and you can just skip down different companies and look at the same thing. So that's getting these forecasts right. And here's the issue. I can't get to the point, it seems, but the real issue is making nice presentations in your Excel of the history and not making absurd forecasts, and then the risk. And this is just magic potion. This is just crap. Here we got this difference in WACC of buying. This is the I don't know, the buyer and the seller. I've done this before, and then you get these enormous differences in valuation from differences in WACC and growth rates. And this is just criminal. Look at this. Ooh, fancy, website, WACC expert. Let's put this in. And then they get these WACCs from 6 to 12. What does that tell you? And it looks all fancy. So that's enough. Now there'll be the Excel technical things to follow up if you want, optional. And I'm going to go through the rest of the lectures. Okay? That's still too long a video. I can't get it shorter. I'm going to keep trying. Bye.